Greetings my dear students. Here we begin a new module, security market analysis. The security market analysis is very important to an investor because it helps him to know the real worth of his holdings. And there are various types of analysis such as fundamental analysis and technical analysis for security market analysis. Okay, a fundamental analyst believes that the efficiency of management, quality of product, financial statistics, etc., such data will help him to choose the apt stock that will contribute towards his profit. Okay, and he also believes that there is no value in analyzing past prices. But in the case of technical analysis, a technical analyst believes that fundamental data is meaningless. There is no need to analyze company aspects, industry aspects, then economy aspects. That is the belief of technical analyst, and he believes that we can predict future price on the basis of past price fluctuations. Okay, so the fundamental analysis and technical analysis are two conflicting approaches. Now we can go through, firstly we can go through fundamental analysis. Fundamental analysis means it's an attempt to examine the company's operations and the market in which the company is operating in order to know the stability and growth potentials of the company. And it also studying about the capital market conditions, the outlook for the national economy, and the economies of countries with which securities prices can be forecasted. And fundamental analysis means the analysis of economic, industry and company aspects to derive a stock's current fair value and forecast future value. Okay, so there are mainly three steps involved in fundamental analysis. First one is economic analysis, second one is industry analysis, and third one is company analysis. And there are mainly two alternative approaches for fundamental analysis. First one is top-down forecasting approach, and second one is bottom-up forecasting approach. Top-down forecasting approach, firstly we are studying about economic analysis, secondly we are studying about industry analysis, and finally we are studying about company analysis. But in the case of bottom-up forecasting approach, firstly we are studying about company aspects, and secondly we are studying about the industry to which the company is related with, and finally secondly we are studying about the industry to which the company belongs to, and finally we are studying about the economy as a whole. And the first step in fundamental analysis is economic analysis. In this step we are evaluating different economic factors as a part of economic analysis, and the first factor is agricultural growth. Indian economy is predominantly agricultural based. The progress of our country depends on the availability of good monsoon and productivity obtained from the agricultural sector. And any progress in the agricultural sector may definitely reflect in the industrial sector also. The agricultural sector contributes about 1/3 of the GDP of our country. Okay, so the second factor is industrial growth. The industrial growth is a major contributor to the national income of a country, and industrial growth helps the overall development of the different industrial sectors and finally reflects in the return and price of the securities. And the third factor to be considered is type of economy, and we all know that there is mainly three types of economy: socialist economy, capitalist economy, and mixed economy. And in India we are following the pattern of mixed economy, where both public and private sector receives equal importance. Government is major investor in industries. The industrial and fiscal policy of the government also plays a very important role for the performance of the Indian economy. So we need to, sometimes there are minor fluctuations and instabilities, so we need to analyze those things also. And by analyzing all these aspects in our economy, we can predict the future dimensions of our savings and investments, okay. And the fourth factor to be considered is business cycle. And there are mainly four stages in a business cycle. First stage is depression, then secondly we are recovering from that is the recovery stage, and finally the prosperity stage, that is boom stage, and finally recession stage. That fluctuations in an economy will reflect in business cycle, reflected as different stages of business cycle. Those are depression, recovery, boom, and recession. And these different stages of business cycle will have a direct connection on the performance of the industries and companies. For example, during depression, companies are forced to reduce their production, and in the boom period they are increasing their production, okay. And the next factor to be considered while economic analysis is gross domestic product. Gross domestic product means GDP. GDP is a national income concept. It means the sum total of all goods and services produced in a country within the domestic territory in an year, okay. And the estimates of GDP will help us to understand the growth and development in the in our economy. GDP helps us to know the growth rate of our economy, and the higher growth rate of GDP is more favorable to the stock market. And next factor to be considered while we are analyzing the economic analysis is savings and investment. The small savings of the investors are mobilized through shares, deposits, mutual funds, etc. For making money available or capital available to the business firms, okay. If the investments are more, it will likely to result in the creation of more employment opportunities, and it helps to generate more income. As a result of more investors find stock as a suitable asset or share as a suitable asset for their investment, the net result will be the increase in prices of the securities. So these aspects we need to consider all these aspects before investing in a security. What is the prevailing situations in the economy, that is need to be considered. And the next aspect is interest rates. We have studied that there is a relationship between stock price and interest rates. We have studied it in the first module as well as in the bond valuation module. And a lower rate of interest means a lower cost of financing, and thereby gives more profit to the companies, okay. And a higher rate of interest will lead to higher cost of finance to the companies, and their profit will reduce. So the fundamental analysts have to examine the trends in money supply and the interest rates before taking a decision about investment, okay. And the next aspect is inflation. As a result of inflation, purchasing power of the people diminishes, and consequently there would be a reduction in demand for goods and services. That will be reflected in the investments case also, okay. But a mild level of inflation is good, but a higher level of inflation is harmful for the industries as well as to the stock market, okay. And the next aspect to be considered is government budget. Government budget gives detailed information about probable expenditure and revenue for a financial year, and it helps us to understand the sectors which have given importance by the government, okay. So the next aspect is political stability. A stable political climate will reflect or will gives or provide better performance of the economy. Different political parties have different priorities. So a stable government will have precise and definite long-term economic policies which will be highly essential for the economic and industrial growth of a country. So Therefore, an analyst must give due importance to this crucial element also while taking an investment decision. Okay, and finally we need to analyze about infrastructure facilities like power, transportation, communication system, and the financial assistance available from banking sectors, etc. If the situations are infrastructure facilities are good, it will be beneficial to the stock market. So these are the main economical aspects or main factors to be considered while we are analyzing the economic analysis. Okay, thank you.